Hello, everyone, and welcome to our August market commentary. Hopefully, you guys are all having a good summer and staying cool. I know there's been a crazy heat wave over the US, and let's jump into it. As always, we have myself, Austin, and Amanda, and today we're going to be doing a quick stock market update, a bond market update, and then towards the end, we'll open it up to a live Q&A. So if you have questions along the way through the presentation, please feel free to put it in the Q&A, and we'll address those at the end. Now, jumping into the stock market update, let's take a look at where we are currently. So it's been a very volatile year. We know that when the tariffs were announced in April, the markets were pretty shook, big correction. But if we look year to date, the S&P 500 is up about 10%, which is a pretty stark difference from that big correction that we saw in April. And if we look at the 3-year average here, the stock market has been averaging 15% per year. So that is a really good 3-year trend for the stock market. You might have noticed your TSP balances have been increasing like crazy because when you're averaging 15% year after year, the portfolio grows exponentially. And another big story that we've been keeping an eye on is how the international has been performing, how the IPE fund has been performing. If we look year to date, that's actually one of the best asset classes that we've seen. The international stocks are up about 20%, which has not been the trend over the last 10, 15 years. The international markets have not performed very well. But that's the story of diversification, where not one asset class is going to perform the best year after year. And that's why we diversify and include the international as well. And interesting trend that we've been seeing, I mentioned it earlier, that big correction that we saw with the S&P down over 20% in April. And now we're above and beyond that. This is not new territory for us, where we have seen a similar story that happened a few years ago when COVID hit. When COVID hit, the stock market was down over 20%. And then a few months later, it was above and beyond where it started. So it'll be interesting to see if this is a similar trend going forward, where we see a correction in the market, there's a quick rebound, or if this is just a couple of one-offs where it was, we don't know how this is going to look at the end, such as when COVID hit, such as when the tariffs were announced, but then there was a quick turnaround with the markets. Another interesting thing that we've been talking about is the Mag 7, which are included in the S&P 500, Facebook, Amazon, Apple, Google, how they've been performing versus the rest of the funds within the S&P 500. If we look at the last 5 years, the Mag 7 is up over 300%, which is a crazy return for just 7 companies. Versus the rest of the S&P 500, yes, it's doubled in 5 years, but compared to over 300%, it's night and day. And looking at the Mag 7 just from 2023, couple of years of return over 200% is pretty stark. So it'll be interesting to see going forward if this trend continues, or maybe are those 7 companies a little overvalued and they'll get a little bit closer to the benchmark.
And perfect. Taking a look at this slide, as we look toward the second half of 2025 and beyond, one thing is really clear. The stock market's ability to move meaningfully higher will depend heavily on the strength of corporate earnings. Now, without solid earnings growth, it's unlikely we'll see sustained upward momentum. And as we'll talk through on the next couple slides on earnings projections there. Now, in the first quarter of 2025, the S&P as a whole delivered, earnings growth of around 13%. But nearly half of that, as you see from the green line there, that 13% growth was driven, just by a handful of the companies, specifically the Mag 7, which includes the tech giants that, Evan discussed there. These 7 companies continue to outpace the other 493 companies in the S&P 500 for 9 straight quarters. So while, headline numbers look strong, the growth story is, highly concentrated in those 7. Now, one of the key headwinds we've been also looking to continue to watch closely is the rise in tariffs. So last quarter, second quarter 2025, we saw how sensitive the market can really be to policy shifts. Now, while the Mag 7 helped keep the S&P 500 afloat, the rest of the index, the other 493 stocks, as you can see, that little yellow sliver, were relatively flat. Now, tariffs, which hovered just under 3% earlier this year, they're now projected to rise into the mid-teens. And as tariffs rise, market or profit margins shrink, and that can eat into earnings quickly. Analysis are still projecting double-digit earnings, growth for the remainder of 2025. But if tariffs rise as projected, that could, alone shave 2% or more off earnings, and risk the underperformance becomes more likely in the end of 2025 there.
And if you
And
don't mind me, you mind if I chime in on that one, Amanda?
yeah,
I think looking back at this over 2023, 24, 25 is so interesting, especially for those of you that have been kind of watching these through the years as we've been doing them, because back in at the end of 23 into 24, we were looking at 5 straight quarters, where the S&P 500 without the Mag 7 were negative. That would have been a pretty significant recession type of situation if those big tech companies weren't there, right? And during those times, you see the earnings growth of the Mag 7 are just beyond off the charts when you look at normal. And the conversation we were having during that time is, there's no way this is sustainable, right? There's just no way we can have the whole rest of the economy be negative and have the Mag 7 be floating everything along. And so we were saying, well, we know this can't continue where the Mag 7 are at 50% earnings growth and the rest is negative. So what's going to happen when the Mag 7 kind of come back to earth? And the positive thing that we've seen through 24 and into 25 this year is the rest of the economy has kind of come along to support, right? So even though we're seeing this earning growth slow a bit in the big tech, we are seeing the rest of the companies can rise up, I guess you could say, which is one of the big reasons that we've really touted diversification and value, and we'll talk about more of that as we go on. But I just wanted to, we haven't talked about this in a while, like the difference between 2023 and what we were seeing to now. And I think this is a really good visual of that and what spooked a lot of people now, and we're seeing how it's kind of playing out. So anyway, I'll hand it back to you, Amanda, but I wanted to pitch that in.
yeah, no, good. Comments there as well, especially when it comes to, what you were saying previously, towards now. But going here, building off the previous slide and Austin's comments, company earnings must do pretty much the heavy lifting, in the second half of the year. Not just investor optimism or inflated valuations. So this chart here shows the S&P 500 is currently trading around 22 times earnings, which historically is high. For context, the long-term average is closer to 16.9 times. And even when we isolate that Mag 7, they're even higher, trading around that 29.3 times earnings, which tells us, one big thing. A lot of investor optimism is already priced in, with valuations already elevated. The range of economic risks on the table with tariffs, trade policy, inflation, beginning to pick up, labor market tightness, interest rates, continuing on and going on longer, could have an effect on these valuations. So markets may see slower growth, unless companies can maintain or improve their margins, which most likely means passing costs along to consumers, which we've already started to see in some sectors. So with valuations stretched and, a lot of those risks still in play, there's really not too much room left for valuations to climb further based on, the chart we're seeing here. And we can go. And the last little bit I'll have, on domestic earnings per share, at the start of the earnings season, the consensus estimate, for the S&P 500 was about 4 to 5% increase year over year. But with about 2/3 of companies now having reported their earnings, we're seeing earnings track well above expectations. Currently pointing to the 10% growth we saw in that first chart I touched on. Really, two main factors are contributing to that growth in the short term, though. Again, I touched on, price increases. We're seeing a lot of companies are charging more for goods and services, as they respond to the economic pressures of tariffs, inflation, interest rates. And the other big one is being share buybacks. Now, many firms are continuing to repurchase their own shares, which mechanically boosts earnings per share, even if total profits stay flat. So looking ahead, the strength of earnings growth will ultimately hinge on how tariffs affect company profit margins. If trade policy becomes more concrete and, essentially more costly, it could start to weigh heavily on earnings despite, price hikes and the buybacks that we're seeing. But I will pass it off over to Austin to touch on some international.
Great. Yeah. So there's a big focus on earnings right now. We've brought it up in a lot of different ways. Earnings, earnings, earnings. What are big tech earnings? What's everybody else earnings? And the reason is because when we think about what's the value of a company, right? What are we investing in? It's not just an idea or optimism. It's in the end, they got to be making money, right? They've got to be showing that they're worth the price that we're paying. And that's been a conversation that we've had all year. And so, where our focus goes when we're trying to decide where's the best place to have our clients' money and our own money, it goes to, okay, who has the best earnings right now? So when we're looking, so far we've talked about the US. We've talked a lot about US companies, but zoom out, there's a whole world of places to invest. And one thing that we've noticed this year, and we've been talking about a lot, is that while the international markets have really underperformed in the last decade, I mean, if you've been tracking the iFund and the TSP, it's performed at about a third of what the C fund has. And it just has felt like the international market was kind of lost, right? Well, with everything that's going on right now and some of the feeling that the rest of the world has about the US at the moment, there's a lot of money being spent in other countries. A lot of development happening. A lot of technology is actually helping some other companies kind of rise to the forefront in certain industries. And so we're seeing growth happen. And if you've been tracking us along and paying attention, we've talked about how this year we increased our exposure to international markets as we started to see some of this happen. And this is where some of that proof is, right? International markets are starting to look pretty good. Now, here comes the other side of the equation. So far, we've been talking about all kind of rosy picture, right? Hey, earnings are ticking up. We outperformed this year. We recovered from this April pullback, and now we're at all-time highs again. Everything's looking great, right? Well, of course, as always, there's risks that come with this as well. Okay. Another way to tell the story that we've been showing with some of this concentration that's happening in the market right now is there's a historically low number of companies that are outperforming the general index, right? Typically it's about 50-50, about 50% are outperforming, 50% are underperforming. That gets you to your average. Right now, only 30% of companies are outperforming the index, and that's because so much of this concentration is happening in a relatively small group. Another interesting thing that's happening is assessing the way people are feeling about the market, right? So if we go to the next slide here, we can see that consumer sentiment, right? We've gone through this year of volatility, and you see in early 2025 consumer sentiment dropped off a cliff. People were nervous. People did not think things were going to go well. If you talk to people back in, February, March, April, we had a lot of conversations with clients where people were just sure that this was the end, right? We're going to see something like 2008 again, and people were obviously very unhappy. Well, fast forward a couple months now, get us where we are. Markets are at all-time highs. What's actually funny about this is typically when markets are at all-time highs, we're in the green zone here, right? People are bullish. People are excited. They're saying, "Hey, I think we're everything is going well." But right now, sentiment is actually at neutral. Now, historically, we've actually shown some charts on this. We were talking about this. We didn't have time to pull one for this call, but we've actually shown charts on this before where historically, when sentiment is the lowest, that equates to a very positive next 12 months or so. When sentiment is the highest, that correlates to a negative next 12 months. The market tends to be contrarian in that way. So when we're at a neutral reading, that's actually a pretty healthy place to be in terms of consumer sentiment. So we'll be tracking this as we go forward, but this is actually somewhat of a healthy place to be for the market right now in kind of this neutral state. Now, tying that into the rest of the conversation here, of course, what would make sense is earnings lead to market performance. Typically, investor sentiment then moves along with that market performance. And so one of the I guess the indicators of how aggressive people want to be or how good they feel about the market is how much of an equity position they hold. How much stock do they hold versus cash, bonds, other things. The more stock someone holds, the more aggressive they are, the better they feel about the market, right? Well, typically you see the green line here, which is your equity, the average equity positioning. How much does the average person hold in the market versus the purple line, which is earnings growth. Those typically track along together. The better earnings are doing, the more someone holds in the market. And when we see big divergences in these, that can sometimes mean opportunity. So what happened earlier this year is everyone sold, right? Tariff announcements happened, the transition of the administration, people sold off their equities. And what we can see is it wasn't because of earnings, it was because of fear, right? Earnings didn't drop that much. People just got scared and they sold. Now we're back to this neutral position where, earnings, yes, they've slowed down, but we're back in line in terms of equity positioning and earnings growth. So it's not, sometimes we talk about money that's on the sidelines or on the table, right? Right now, earlier in this year, there was a lot of money on the sidelines. People had moved money out of the market. Now that money has re-entered the market back into what we'd call kind of an average place. So, a final thought in regards to this here is, in terms of the stock market, is a lot of times I know that we talk about the market kind of in a vacuum, right? That's our job. We're very focused on the market. We're investing for you guys. That's what we do. But another thing that's, I think, important to understand is the broader picture. And one thing that we've noticed over the last couple of years is for people that are invested, like you and us, and are solely focused on the economy from that perspective, things are going very well. For people that are not invested in the economy, maybe they don't have the means to do that, or they are lower income. We're really seeing the impacts of inflation start to hit these people, right? There's becoming a separation between owners and general workers. And that's starting to play out in different ways. One of those ways that we can see is delinquencies on credit cards and auto loans, right? So you can see through really since COVID, right? trending up through 2024, we've seen delinquencies really start to rise. Typically, when that happens, it's not great, right? We see some periods here where recessions have happened following rises in credit card and auto loan delinquencies. Okay, we are kind of starting to see this turnover right now. This is something we're going to be looking at, but I don't think it's fair always to talk about how the stock market's doing in a vacuum without zooming out and looking at the big picture, because obviously this will play a big part going forward. So, from there, Evan, why don't you tell us a little bit about what's going on in the bond market with interest rates these days?
So zooming back into the bond market and interest rates, how have bonds been performing year to date? Bonds have been performing pretty well, where year to date up about 5% in the bond market. This is what we expect on an annual basis from the bond market, not a 6-month period. But I think the reason we've seen them perform a little bit better is the decrease in interest rates and also higher yields. Because the rates increase, these bonds are paying more. We've seen that they've been more resilient and performing pretty well. But if you look over the 3-year, how bonds have been performing, not as well, unless you look at the short-term bonds. Those have been performing a little bit better. But I think the long story short here is, going forward, we don't necessarily see bonds as a huge opportunity, but doing their job within the portfolio, giving you that more conservative investment, being the ballast of the portfolio. And taking a look at what we see for interest rates going forward, the Fed just met and announced no cuts, but the anticipation is still a few more cuts coming in 2025. And we do see that being the goal going forward, is cutting interest rates a couple more times, where right now we're close to mid 4s, and towards the end of the year we might be closer to the 3s. And it's interesting to look at historically, when a new Fed chair is elected, what happens to interest rates. If we look historically, pretty much every time a new chair is elected, we see an increase in rates. But one thing to mention there is, it's not rates are decreasing, there's a new chair elected, and then rates skyrocket out of nowhere. It's kind of continuing the trend where a new chair is elected as rates were rising anyways. So just interesting to note, to see if with the new chair being elected at some point, if we continue to see the trajectory that we've been seeing.
Yeah, and one thing I wanted to pitch in here, because if we go to the next slide, we talk about rates a lot, right? We talk about, but typically when we're talking about rates, we're focused on the short-term rate, what the Fed controls, and that if we make a change to the Fed chair, there's going to be a big, immediate difference, right? That's kind of the narrative that's being shared right now on the news. And there's a couple things with that. One, the Fed chair is one person on a board of many people. The board votes, they make a decision. Changing the Fed chair is not necessarily cutting the head off the snake, right? He doesn't have, sole control there. So that's one piece of it. Now, another piece of it is that short-term interest rates, the rates that the Fed controls, really doesn't impact much of our everyday lives. There's kind of this narrative that, rates need to come down so my mortgage will drop. Well, those two things are not explicitly tied. Mortgage rates and auto loan rates and anything that's longer than 5-10 years is more so based on the 10-year treasury, okay, or longer term interest rates. And the 10-year treasury truly isn't very impacted by the Fed rate decision. The 10-year treasury is more of a gauge on where people see our economy going over the long run. Are people and other countries comfortable investing in the US economy over the next 10 years and being sure that the US is going to be able to pay back their debt, right? That's what drives the 10-year treasury. So this is more of an indication of economic strength and confidence, I guess. Well, another indicator of economic strength and confidence is the value of the dollar itself. Okay, and so what this chart is showing here is how historically, and I know that's only showing a couple years here, but historically there's a fairly tight relationship between the value of the US dollar, shown in purple, and the yield on the 10-year bond, shown in red. And something interesting that's happening right now is the value of the dollar has been kind of on a steady decline since the beginning of the year, and the value or the yield on a 10-year treasury has been flat. There's a disconnect happening. There's a kind of a sign of economic weakness, I guess, within the devaluing of the dollar. But for some reason right now, 10-year treasuries are not following that down, and a lot of that has to do with the fear that inflation is going to pick back up. Okay, and so what's going to be interesting is over this next few months, year, seeing if our inflation data continues to support the fact that interest rates can stay down meaningfully, and if we can see that 10-year treasury continue to decline. So, I know this is a bit obscure here, which is why I wanted to spend a little time talking through it. But that's going to be something that we pay attention to over the next few months as well.
All right, couple of final thoughts here. Amanda, tell us a little bit about passive versus active management.
Yeah. One trend that's, we've been seeing over the past decade, is passive investing has actually surpassed active investing in terms of total assets and will continue to grow. Now passive investing typically involves buying into an index or asset class without active oversight. This means you're automatically investing in all the securities included in that index, regardless of, their valuation, quality, risk profile. It's really a set it and forget it approach, which, can be both strengths and a weakness among, other benefits, low costs, market exposure, and they're simple, and just rules-based approaches there. But what are really the risks of that? While passive investing obviously has its advantages, we think it's important to recognize really four main risks that come with it. First, passive, funds buy everything in that index, regardless of the price. There's really no analysis of whether a stock is overvalued or undervalued, and really removes, a critical market function of price discovery. Second, because passive investing is rules-based, there's no judgment about quality. Expensive or risky companies are included just as, easily as stable, profitable ones. There's really no gatekeeping analysis when it comes to passive investing. Third, passive strategies also result in simultaneously, buying and selling across entire indexes, which leads to increased correlation among assets, really reducing the benefits of diversification that, investing is supposed to provide. And lastly, it doesn't allow for tactical shifts in response to outside, emerging risks, as we've been seeing, or just market opportunities. So when we think about active managers, in contrast, they can make adjustments based on, current market conditions. Think buy low, sell high, or just company fundamentals like their balance sheets. So kind of in conclusion for this slide, passive investing, as it remains, a powerful tool for many investors, offering simplicity, cost savings, really when investors are doing being their own investment manager. But based on those risks, we actually prefer active funds in many of our portfolios to provide that additional layer of analysis to really sift through those thousands of investments there are, to pick the ones that go through a specific due diligence process, not just, buying everything and anything in that index.
And especially in a couple of specific asset classes, like the small cap US companies, those might need a little bit extra filter. Bond market might need a little bit more active management, and international investments as well. Those are just some of the areas that might need a little bit more oversight.
Perfect. And just to reiterate, in today's market, defending a portfolio and diversifying risk does require a new approach. That issue being, exposure to that large cap growth, especially when we took an earlier look at the Mag 7 as compared to the rest of the 493 stocks that make up the S&P 500. Now, large cap growth stock, especially tech, still form the core of a lot of portfolios in an index investments there. So, meaning many investors are overexposed to that one sector, really increasing the vulnerability should there be a market downturn. So as we see traditional defensive sectors, like in the chart here, utilities, consumer staples, and healthcare, which once helped protect portfolios in volatile times, now makes up a smaller share of the market, really reducing, their impact as defensive tools when investing in indexes. So one of our approaches, our solutions is really to go beyond these traditional defensive equities. Two of them that we're currently using is something called a low volatility strategy. We have an alternative long short fund we're currently utilizing in our portfolios, as well as, other non-equity investments like structured notes that we use in tandem with a lot of our model portfolios for clients. As these can really serve as, the modern day shock absorbers, changing the market landscape there.
Yeah.
And I can.
Yeah, and just a couple thoughts on those two slides, and if you're a client of ours, you've kind of seen this firsthand, some of the updates we've made and within the portfolio. One of those being that we're practicing what we preach about the values and revenue based investing. One of the things, there's a reason for that first slide that Amanda showed that shows the percentage of people going into passive investing is much higher, especially within the US. And that's specifically what this chart shows is for US funds. There's a reason for that, because the research says that it's really difficult to beat the index. The US indexes have done very, very well. Active managers have struggled to outperform. And so there's a reason that that passive management is used. What our thought is, and like what Amanda said, the thing that's scaring us a little bit with the passive index is there's no filters for, revenue or quality or anything like that. And so it adds to this concentration problem. So one of the tools that we've started to use is using something that it's passive in the way that it follows an index, but it just weights it in a different way. It's using all the same companies. It's just not weighting it by the size of the company. Instead, it's weighting by revenue or by quality or by something else. And then again, in international and small companies, those are the places that we're using more active investment. So and again, I want to tie this back to the TSP, because I know a lot of you are in the TSP. Is passive investing, that's what you have at the TSP, right? That's the C fund, S fund, I fund. It's all index investing in the S&P 500 or the international index. And passive investing makes a really good way to in the accumulation phase. It's a really good way to invest in the accumulation phase of life. When you're young and earlier in your career and you just want to set it and forget it and, follow the index, that is an amazing way to invest. The reason we add in some of these more active strategies is more so when we want to start taking risk off the table. Okay, so I just wanted to mention that as well, is it really depends on the timing of your career, and when you want to start taking risk off the tables, when some of these active strategies start to play a part, and we can be a little bit more defensive. So now, Evan, if you want to go to the bucket strategy, and I'll wrap up from there. But oh, sorry, I'll talk about this one here first. Before I get into that, I kind of forgot about this slide here, so I do want to talk about this with you guys though. So going into this part of the year is something that we kind of strategize around. August, September, into October are typically the worst performing, is kind of the worst performing months of the year. Now, of course, history, you know, like they always say, past performance is not an indication of future results, right? We can quote that. So this isn't a given by any means, but again, those of you who are clients, this time of year is typically when we're targeting doing things like Roth conversions, things that we want to do while the market's down, especially when we've seen a year where it's just gone up, up, up. So this time of year is where we'll start looking for some of those opportunities if we do see a pullback. Another reason I want to bring this up is anytime there is a pullback in the market, people get a little spooked, right? It's kind of normal for this time of the year. It's kind of normal for settling in after summer. We're waiting for Q4 earnings, kind of see how things shake out. So we'd always just like to bring this up at this point of the year. Don't be alarmed if we do see a bit of a pullback, especially after we've seen the market up the way that we have this year. So going to the next slide here, this is the bucket strategy that I was talking about. And this ties into what I was saying before, where as we get closer to the ending of a career, we want to start being really mindful of the risks that we're taking. And the absolute core of that, what we work through with every client who's entering into retirement or starting to need money from their portfolio, is like thinking about your risk, you know, profile is one thing. How much risk am I willing to take? But something else we need to really, really be mindful of is, when are you going to need money and how much are you going to need? This is the core of our strategy for every retiree. Okay. If you're going to need money in the next 3 years, no matter how aggressive you are, if you need it in the next 3 years, that money cannot be in the market, right? Because we just know there's too many things that can happen in a 3-year period. We've seen too many 3-year periods over history where the market's down, and we can't afford you to not have that money when you're going to need it, right? If something drops. Then we go out another 3 years. That's kind of our buffer timeline. This is typically what we're using bonds for. Things like, you know, market linked notes or protected equities. There's different strategies for this. And then we go out into the long run. If you're not going to need money for 7 or more years, that's what we have in the market. So without fail, you know, we always get questions saying, hey, I'm this old, how should I be invested? Right? Or how do you recommend I invest within the TSP? Well, this bucket approach is our framework for that. So short term, and this is what I should say here to put a caveat on this. These are our, we'll call them minimum requirements. You might be more conservative than this, and this is okay, right? But these are minimum requirements. If you're going to need money in the next 3 years, put it in TSP fund terms. That's something like G Fund. Money that you're not going to need for 4 to 6 years, put it in TSP terms. That's something like F Fund, like bonds. Money that you're not going to need for 7+ years, you know, that's something like C, S, and I. So to wrap it up here, just kind of some final thoughts. We share these every time. I don't think they ever get less important. In good times and bad, don't let emotions drive your decisions. Right now, it can be really easy to say, well, heck, let's put it all in the C Fund because that's what's done the best over the last 3 years, right? Absolutely. Don't let emotions drive your decisions. History would tell us when that's been the case, it doesn't stay the case forever. Understand the risk you're willing to take. If April scared the pants off you, that means you're too aggressive. Okay. If April had you to the point, or you know, February through April when the market dropped 20%, if that had you to the point where you wanted to sell everything, we need to reconsider how you're invested and what your plan is. If you've got a plan, you should not be feeling like that when that happens. Okay. You know your time horizon, like we talked about the bucket strategy. Be diversified, stay invested. These are just important things to know. Okay. So we'll wrap up here. I'll mention a few things. Right, we've got the Q&A open. I see people we've got some questions in there already. We'll get to those here shortly. Another thing to know, right, I've been watching the participants on this. It kind of increased as we were going. So if you missed the beginning, this will be posted on YouTube. Okay, so if you missed the beginning of this, just go back and watch it on YouTube, and you catch the beginning there. But then, yeah, let's get into some Q&A. Oh, before we get into the Q&A, let's go to the next slide real quick. For those of you who are clients of ours, you know that you can reach out to us anytime, right? If you're not a client of ours already, you're watching this on YouTube, or you're you know, just visiting on the live webinar, we have this free financial checkup. We've actually changed this to more of a retirement oriented, I guess, one-on-one session. So what this is it's a one-on-one session with me, Evan, Amanda, with one of our advisors. And we really think this is the most impactful. We'll call it 3 to 5 within 3 to 5 years of retirement. And we really cover these strategies on how to de-risk yourself and start preparing for that retirement cash flow situation when it comes to investing your TSP, investing outside the TSP, tax considerations to make with that. And if you're getting to that point where you're getting close to retirement, you need to think about how to change the strategy from the accumulation phase into the spending phase. This is an amazing opportunity for that. So it's free. If you want to do that, you can hit the QR code or go to retfed.com/register.